We are in recession, but how do we get out of it as quickly as possible? Although the central bank's governor and the Minister of Finance have said this recession will be short-lived. Okay, let's get another perspective from Ayodeji Ebo. Good morning, Mr. Ebo. Always a pleasure to have you on the program.
Good morning. Thanks for having me.
First, how do you compare this period to the 2016 recession? It is glaring the coronavirus pandemic played a major role in this downturn, but I would like to get your perspective.
Okay, thank you. So looking back to 2016, we'll look at the major factors that contributed to that, the recession we had. It was majorly the decline in global oil prices, which impacted on government revenue. And that led to scarcity of FX, which now impacted on businesses. And if we look at comparing that to what happened this year, we can also link it largely to the same major reason, which is a major drop in revenue. But if we also try to dissect, looking at the impact, so the oil sector, oil revenue still continue to account for a major part of government revenue. Yes, during the budget is always very minimal, but in terms of actual performance, you see, based on 2020 performance so far, is about 47% oil revenue out of the total revenue for looking at half-year reports. So whatever distortion that comes out would always impact on the performance of the economy. But looking at the COVID-19 pandemic and how that has impacted, this also led to restriction of businesses. So that affected both revenue from the oil sector and the non-oil sector, which had a major impact. And that's why you could see that for the Q1 GDP data was about 6.1%. And we've seen that improvement in the Q3 data, which is about 3.62%. So when you look at the GDP on a nominal basis, on a quarter-on-quarter basis, business activity improved. And that's part of what is informing even the projection of the CBN governor and the Minister for Finance that in Q1 2021, latest in Q1 2021, we may be out of the woods.
Now, there seems to be a lot of discussions around the revenue diversification, but the actual revenue structure remains skewed towards oil. What are the steps do you think the government can take now to achieve this in the medium to long term?
Okay, yes, these discussions have always been going on, and for most of the recommendations, there will be nothing significantly new. And we also have policies that we expect that should help drive this diversification. So I think for government, just to intensify effort on looking at what are those top sectors and looking at the multiplier effect that would increase activity as well as generate employment. The job elastic sectors that will generate employment. So if we take, for instance, we know the agri sector accounts for a major part, and a lot of policies there are a lot of initiative within that space for us to reduce the amount of importation of food or the major items. And I think there's a bit of results that we're seeing within that space. But how do we now move on to, how do we take it forward so that we begin to see that major impact within that sector? We need to look at our yield per hectare. What kind of seedlings are we using? So that if our peers, in terms of, if you look at for rice, for instance, if the yield per hectare is about 0.7 metric tons, for us, how do we now take it up to that level so that the effort we're putting will be yielding significant results? If you also look at the value chain within the agri sector, storage is also a major factor that leads to that price fluctuation. So you will see that seasonality in terms of prices. How do we want to take care of that? And that would also create a lot of employment and increase activity. Secondly, looking at the manufacturing sector, I would re-emphasize that there needs to be a major national development plan that even outlive the current government. We need to begin to implement those policies. It's good we're on looking at the ease of doing business. Yeah, trying to see how we want to improve on the ranking. Can we look at the manufacturing sector? The SME accounts for over 90% of the activity within that space. What are those major enablers that we need to put in place? We need to look at infrastructure. If we look at how the structure of the budget is, you would see that, yes, this year we're having close to 30% allocated to capital expenditure, but at the end, when there's a bit of struggle to grow revenue, capital expenditure is always at the receiving end. And this is what will create that enabling platform for the SMEs to be able to produce at a competitive price. So we need to focus on that. Government does not have that resources, so there needs to be more deliberate effort, regarding partnership with the public sector on creating infrastructure. Transportation is key. The rail system, for us to increase the speed and for us to get to a growth level that will be sustainable and will be above population growth rate, we need to take care of the transportation network. And private sectors should be the major promoters of this. Then lastly that I will speak on is on trade. We need to look at what are those policies that will facilitate trade. We need to be deliberate about those policies, and with that we'll be able to improve the activity within that space. So by and large, in summary, most of these initiatives, I know it's more of now the willpower or the political will to implement some of these policies and to follow them through. Then we'll begin to see the impact on most of these sectors, and we can achieve a growth rate that would be above population growth rate.
What role do you think the capital market can play in uplifting the economy at this time?
Okay, great question. The capital markets, I would like to look at it from two perspectives. You have the equities and you also have the fixed income. Also looking at it from the individual perspective as well as from the corporate perspective. So starting with the equities market, if you look at the equities market in the last 2 months, we've seen that market has gained about 4 trillion. So when you look at it, means that the wealth of the average Nigerians have increased by about 4 trillion. They have been empowered, and that in a way also increases the spending capacity of the average Nigerian, those that have invested within the stock market within that space. Also looking at for the fixed income, we know we're approaching almost a negative yield environment within that space. So for the average investors, we'll be looking at other alternatives that would help support. So from the way the capital market will provide support would be the wealth that the average individual is able to create from the capital market. For the corporates, for instance, the low yield environment is a major support for most of the corporate guys. If you are able to raise instrument or raise funding at a lower rate, it's also a plus to your profitability, and sometimes it may even have impact on the cost of production, because if you need to borrow to produce and the rate is cheaper, that would have its impact on the cost of inputs, and that would also reduce the cost of the selling price. So by and large, tapping in within this low yield environment, tapping into the capital market at this lower rate, raising both short-term funding for working capital and long-term funding probably for expansion, would have a positive impact on input prices and would also bring down cost of goods, and that would also support reduce the cost of living for the average Nigerian. So by and large, the capital market is a place that can help support that growth. We believe that even for government, some of the initiative of trying to privatize some of the what we call debt capital, some of the companies that may not be performing optimally, we can use the capital market to raise such funding. We can use that to diversify even our revenue structure, and that creates some form of accountability, because once you are quoted, it means that there's a level of demand, accountability, and transparency that those parastatals that are quoted will need to also be exhibiting, and as a result, that will also reduce leakages. So I believe that there are a lot of opportunities that the capital market can provide and can support to increase the wealth of the average Nigerian.
Now, you talked about the low yield environment in the fixed income, which of course benefits the corporate. But what about an average investor who perhaps will want to invest in fixed income? So that's discouraging.
Yes, I quite agree with you that it's discouraging, and now would even have for the average Nigerian individuals, there's no incentive for them to invest in fixed income. So what that would prompt is that investors will begin to look for alternative. So when you look at Eurobond, for instance, yield within the Eurobond space is around between the 6 for FGN's Eurobond is around 6 to 8%. Investors will begin to look at long term to enjoy that rate, and also there's that advantage of trying to hedge against if there's any adjustment of the naira. There are also dollar denominated assets. So for the individual, if you cannot purchase Eurobond based on the standard size of $200,000, there are mutual funds that are self-regulated that have been created that you can also invest in to earn higher return, and that will help you close that gap between the inflation rate of above 14% and the zero yield environment. Also, we've been structured products, but before anyone, I would advise that you understand what kind of structure the underlying assets, understand the business which creates that underlying asset, and ensure they are regulated before you also invest in those structures. But most of the structures we'll be having now will more of the long term. So it means that investors need to move from that short-term view to that long-term investment view, and that is how you can be able to earn higher return. When you look at the maturity analysis or maturity analysis of the banks in terms of their deposit, you will notice that over 60 or 70% of them would mature within 90 days. So that short-term view, we know that it is a part of Nigerians that we don't like investing for long term. But based on this current yield environment, it means that for us to enjoy or to bridge that gap between inflation and the yield environment, you need to be thinking long term to enjoy that interest rate.
So tell me, what shape of recovery is most likely? What shape of recovery are we likely to see? We have a U, we have a V. I know we've seen a V-shaped recovery in China and in the US. Just wondering what kind of recovery we're likely to see. I'm even seeing an L. I don't know if that applies, or a K. So what shape of recovery are we likely to see?
I think for looking at the way we have been progressing, I would go for the U. What that means is that it's going to be gradual. It's not going to be very sharp. We've seen Q2 was down. We've seen that improvement in Q3, and we expect, though we would still be in negative region, but would also be a bit marginal. We are projected between 1 and 2%, despite the impact of COVID-19, because we expect that business activity has also increased. So there are a lot of activity that should have held at the beginning of the year, or Q2, Q3. Most of them are being pushed into Q4. So that would also spur activities, and we believe that it's really going to be you. Then for the first quarter, because of also that base effect, the growth rate, even if it's positive, would also be marginal. But from Q2, looking at also the base effect, we may see that high growth rate because of if you recall, 6.1% in Q2 2020. So when you're comparing it to Q1 2021, then you may likely have a growth rate that may be higher than population growth rate. But we need to look beyond that and look at the sustainability. What do we need to do to sustain that momentum such that we don't get to 2022 and because of the base rate, we begin to record a very fragile growth rate. So in summary, I would go for the U. I don't expect Nigeria to have that V shape, and I also don't pray for the W, that we go up and come down.
All right, thank you very much, Senior Economist and Head of Research Strategy at Greenwich Merchant Bank, Ayodeji Ebo. Always a pleasure to have you on the program.
Thank you.
Okay, let's look at the market, and we're talking to a stockbroker there, Charles Fakruga. Good morning, Charles. Thank you for joining us. Hello, Charles. Well, I guess he's not ready to talk to us, but let's look at what the activity was like yesterday. The market recorded, the equities market, by the way, third consecutive gains this week. The all-share index notched up 0.1% increase to 34,803 points. The performance was supported by gains in Guarantee Trust Bank, which went up 2.6%. International Breweries was up 9.6%, and Mobile 9.9% up. Now, the month-to-date and year-to-date return increased to 14% and 29% each. The total volume of trades decreased by 40.8% to 257.56 million units. Okay, we have Charles Fakruga now. Okay, Charles, good morning. So, have we seen the last of the bear in the market for this year?
No, I don't think so. We are approaching the festive period. It's already started. We might see some bits of profit taking again. Specifically for what I'm even seeing today, the market is likely going to close in the outward territory.
So this is the last trading day for the week. Well, if it happens that the market closes in the red today, how would that play out next week?
Yes, for next week, we are looking at there's going to be a little bit of stock go between the bears and the bulls. We'll see some days of positive trading and some days of negative trading. It's not unexpected because it's so much pressure on selling. There is time. Looking at you will see that for you, more and more people who want to take what and come because that is the place.
Here we go again. All right, Charles, thank you very much.
Good return. Thank you for having me.
Yes, I wish you a profitable trading day. Everyone, we'll take a break, and when we come back, we do an opening call to London and look at the debt and currency market here. Do stay with us.